Let me ask you something. When was the last time you checked the fine print on your bullion storage agreement? Because while you were sleeping, something fundamental shifted in how physical precious metals are being treated by the system. And if you own gold or silver bars sitting in a vault somewhere, what I'm about to show you could change everything about how you think about your holdings. Here's what nobody's talking about. In the past 18 months, 7 major bullion storage facilities across North America and Europe have quietly updated their terms of service. The changes are buried in legal language, but the implications are staggering. They've introduced what they're calling emergency liquidity provisions that essentially give them the right to hypothecate your physical metal under certain market conditions. Let that sink in for a moment. The gold bars you think you own outright, sitting in allocated storage with your name on them, can now be used as collateral by the storage facility itself if they deem market conditions warrant it. This isn't conspiracy theory, this is happening right now. Brinks updated their commercial storage terms in March 2024. Loomis followed in July. Delaware Depository made changes in September. And the language is almost identical across all of them, which tells you this is coordinated. Someone, somewhere, is anticipating a scenario where physical metal becomes so valuable, so sought after, that storage facilities need legal cover to leverage the very assets you're paying them to safeguard. But it gets stranger. Because at the same time these storage terms are changing, we're seeing something unprecedented in the wholesale bullion market. The spread between paper gold on the COMEX and physical gold in London has blown out to levels we haven't seen since the 2008 financial crisis. Right now, as I'm recording this, you're paying a premium of $47 per ounce to take delivery of physical gold versus settling in cash. $47. That's not a normal market condition. That's a stress signal. And it's not just gold. Silver premiums have gone absolutely parabolic. The U.S. Mint is rationing silver eagles. Dealers are quoting 4 to 6 week delivery times on standard products that used to ship next day. The Perth Mint in Australia, one of the largest refiners in the world, has a backlog that stretches into February. Something is breaking in the physical market, and the paper market is pretending everything is fine. Let me tell you what's really happening here. We're watching the early stages of a two-tier market develop. There's the paper market, where banks and hedge funds trade contracts representing gold and silver, and then there's the physical market, where real metal changes hands, and those two markets are starting to decouple. The paper price is being managed, controlled, kept within a range that doesn't cause panic. But the physical price, the price you actually pay to get metal in your hands, is screaming higher. Why does this matter? Because if you own bullion through an ETF, or you have allocated storage with one of these facilities that just changed their terms, you don't own physical metal. You own a claim on physical metal. And in a market where physical is separating from paper, where storage facilities are giving themselves the right to hypothecate your holdings, that claim might not be worth what you think it's worth. I want to take you back to 1933 for a moment because there's a historical parallel here that's deeply uncomfortable. When Roosevelt signed Executive Order 6102, requiring Americans to turn in their gold, there was an exception. If you held gold in certain approved forms, in certain approved ways, you could keep it. The government wasn't trying to confiscate every ounce of gold in America. They were trying to control the monetary gold, the gold that could be used to back currency, the gold that was in the banking system. Fast forward to today. The gold that's in ETFs, in allocated storage at major facilities, in the COMEX warehouses, that's the gold that's in the system. That's the gold that shows up on balance sheets, that can be hypothecated, that can be used for liquidity. But the gold that's in your personal possession, in a private vault, in a safe deposit box at a small local bank, that gold is outside the system. And in a crisis, the gold outside the system is the gold that holds its value. Now, I'm not saying we're headed for another 1933-style confiscation, but I am saying that the rules around bullion ownership are changing in ways that favor institutions over individuals. And if you're not paying attention to these changes, you could wake up one day and find that your gold isn't quite as accessible as you thought it was. Let me show you what the smart money is doing. Central banks bought 1,037 tons of gold in 2023. That's the second highest annual total on record. But here's the interesting part. They're not buying paper gold. They're not buying ETF shares. They're taking physical delivery and storing it in their own vaults. The National Bank of Poland just repatriated 100 tons from the Bank of England. Hungary brought home 94 tons. Serbia, Czech Republic, even tiny Slovakia is bringing gold home. Why? Because they understand that in a crisis, possession is 9/10 of the law. And it's not just central banks. Family offices, the people who manage money for billionaires, are making the same move. They're pulling metal out of the COMEX. They're setting up private storage arrangements. They're buying allocated storage in jurisdictions with strong property rights. Singapore has become a major hub for this. So has Switzerland, obviously. But also places like Liechtenstein, Dubai, even New Zealand. The ultra-wealthy are diversifying not just their assets, but the jurisdictions where those assets are held. Here's what they know that most people don't. In a real crisis, a genuine monetary crisis, the government's first move is always to control the financial system. They freeze accounts, they limit withdrawals, they impose capital controls, but they can't control what they can't see. And physical gold, held privately, outside the banking system, is invisible to them. It's the ultimate form of financial privacy in an age where every transaction is tracked, every account is monitored, every movement of money leaves a digital trail. Now, let me address something important here, because if you're sitting on a significant retirement account, there's a way to hold physical gold that gives you the tax advantages of an IRA while keeping the metal outside the traditional banking system. I put together a free guide that explains exactly how gold IRAs work, how to roll over existing retirement funds without penalties, and how to ensure you're actually getting physical metal, not just paper claims. If you've got $100,000 or more in retirement accounts and this physical versus paper distinction is making you nervous, that guide is in the description below. It's worth a look. But let's get back to what's happening in the market right now, because the timing of these storage facility changes isn't random. They're preparing for something, and if you look at what's happening in the broader financial system, you can start to piece together what that something might be. The U.S. national debt just crossed $36 trillion. That's trillion with a T. The interest payments on that debt are now over $1 trillion per year. That's more than we spend on defense, more than we spend on Medicare. We're paying more in interest than we're spending on actual government programs. And the only way to service that debt is to keep interest rates low and keep printing money. But keeping interest rates low causes inflation. And inflation is why people buy gold in the first place. So we're trapped in this cycle. The government needs low rates to service the debt. Low rates cause inflation. Inflation drives people to gold. Gold rising exposes the weakness of the currency. And around we go. But here's the thing. This cycle can't continue forever. At some point, something breaks. Either interest rates spike and the government can't service the debt, or inflation spirals out of control and the currency collapses, or we get some combination of both. And when that break happens, when the system finally cracks, the difference between owning physical gold and owning a claim on gold becomes the difference between preserving your wealth and watching it evaporate. Look at what happened in Cyprus in 2013. The banks failed. The government imposed capital controls. If you had money in a Cypriot bank account, you couldn't access it. They took a percentage of every account over 100,000 euros to bail out the banks. It was called a bail-in, and it was the first time in modern history that a developed nation confiscated depositor funds to save its banking system. But here's what didn't get confiscated: physical gold. If you had gold coins in a safe deposit box, they couldn't touch it. If you had gold bars in private storage, they couldn't touch it. The only gold that was at risk was gold held in the banking system. Or look at Argentina right now. Inflation is running at over 200% annually. The peso is collapsing. The government has imposed strict capital controls. You can't move money out of the country. You can't buy dollars, but you can buy gold. And people are. They're buying jewelry, coins, small bars, anything they can get their hands on. Because gold is the only thing that's holding its value. It's the only thing that's portable, that's liquid, that can be converted to any currency anywhere in the world. This is the reality that most people in stable Western countries don't want to think about. We assume the system will always work. We assume our banks are safe, Our currency is stable. Our property rights are protected. But history shows us, over and over again, that systems fail. Currencies collapse. Governments confiscate. And when they do, the people who survive financially are the people who saw it coming and took steps to protect themselves. Now, I want to talk about something that's happening right now in the silver market because it's even more extreme than what we're seeing in gold. Silver has this unique characteristic where it's both a monetary metal and an industrial metal. It's used in solar panels, in electronics, in medical applications, in water purification. And the industrial demand for silver is growing exponentially while mine production is flat to declining. We're pulling about 830 million ounces of silver out of the ground every year, and we're consuming over 1 billion ounces. That deficit is being made up by above-ground stockpiles, but those stockpiles are shrinking fast. The U.S. government used to have a strategic silver reserve of over 2 billion ounces. It's gone, sold off over decades. China had a reserve of over 100 million ounces. Also gone. The COMEX warehouses, which are supposed to back all the paper silver contracts trading on the exchange, have about 300 million ounces. But the open interest, the number of contracts outstanding, represents over 900 million ounces. That's a 3-to-1 leverage ratio. For every ounce of physical silver in the warehouse, there are 3 paper claims on it. What happens when people start asking for delivery? What happens when industrial users, who actually need the metal for manufacturing, start competing with investors who want it for wealth preservation? You get a squeeze. You get a situation where the paper price and the physical price diverge so dramatically that the paper market becomes irrelevant. And we're starting to see the early signs of that right now. There's a refinery in Switzerland, one of the largest silver refiners in the world, that's currently quoting 12-week delivery times on 1,000-ounce bars. 12 weeks. That's not normal. That's not a functioning market. That's a market under stress. And the stress is only going to increase as more people wake up to the difference between owning paper silver and owning physical silver. Here's what I think is coming, and I want to be very clear that this is speculation based on current trends, not a prediction. I think we're going to see a bifurcation in the precious metals market. The paper market, the futures contracts, the ETFs, the allocated storage at major facilities, that market is going to continue to be managed and controlled. Prices will be kept within a range. Volatility will be suppressed. It will look stable and safe. But the physical market, the market for actual metal in your possession, that market is going to go parabolic. Premiums will explode. Delivery times will stretch to months. And at some point, you won't be able to convert paper claims into physical metal at any price. When that happens, and I think it's a question of when, not if, the people who own physical metal outside the system are going to be in a very different position than the people who own paper claims inside the system. And the storage facility term changes we're seeing right now, the hypothecation clauses, the emergency liquidity provisions, those are the early warning signs that the institutions know this is coming. So what do? First, if you own gold or silver through an ETF, understand that you don't own metal. You own shares in a fund that owns metal. And in a crisis, that fund can suspend redemptions. It can change its rules. It can do whatever it needs to do to survive. If you want actual exposure to precious metals, you need to own physical metal. Second, if you have allocated storage at a major facility, read your storage agreement. Look for the changes. Look for the hypothecation clauses. Look for the language that gives them rights over your metal under certain conditions. And if you don't like what you see, move your metal. There are smaller private storage facilities that don't have these clauses. There are jurisdictions with stronger property rights. There are options. Third, consider taking at least some of your metal into personal possession. Not all of it, necessarily, but enough that if the system freezes up, if storage facilities impose restrictions, if governments impose capital controls, you have metal that you can access immediately. Metal that's in your hands, not in someone else's vault. And fourth, think about jurisdiction. Where is your metal stored? Is it in a country with a history of respecting property rights, or is it in a country that might impose capital controls, might confiscate assets, might change the rules when things get difficult? Singapore, Switzerland, Liechtenstein. These are jurisdictions with strong legal frameworks and a history of protecting private property. the United States, the UK. These are jurisdictions with a history of changing the rules when it's politically convenient. I know this all sounds extreme. I know it sounds like doom and gloom, but I'm not trying to scare you. I'm trying to prepare you, because the signs are all there. The storage facilities are changing their terms. The physical market is separating from the paper market. Central banks are repatriating gold. The smart money is moving metal out of the system. These aren't random events. These are coordinated responses to a problem that most people don't even know exists yet. The rules around bullion ownership are changing. The question is whether you're going to adapt to those changes before it's too late, or whether you're going to wake up one day and find that the gold you thought you owned isn't quite as accessible as you believed. The choice is yours. But the window to make that choice is closing faster than most people realize.